Hello, everybody. Welcome to the Trading with Ashley show. A little bit change of scenery. I am sitting in my kitchen, so just thought I would change things up a bit for you. But today is my Leaps Freedom Day. What does that mean? That means my leaps that expire in December of 2027, they finally have the amount of profit in them that I could start selling shorter dated calls against them. It's called the poor man's covered call. And most of you remember one of my most watched videos that explains how to go about purchasing a leaps on the SPY or the Qs and then using that leaps to generate weekly, even daily or monthly income with the leaps using a poor man's covered call. I will leave that particular video in the description. But what this means is today is the day that when you take my strike price for my leaps and you add the price I paid for the leaps, when you add those two together, we're finally at the break-even point. And it actually did not take that long. It's been just about a month since I purchased the leaps. So what that means is now I can go forward selling calls against it and not have to worry about taking a loss. So let me explain what that means. So if you purchase a leaps, you're basically purchasing the right to buy a stock or ETF at that price at some date in the future before your expiration date. Well, most brokers, they allow you to use that leaps so that you can then turn around and start selling shorter dated calls against it because your leaps is securing the trade. Basically, what would happen if you sold a call against your leaps and it was exercised by the buyer? They're going to want their 100 shares. Well, if you don't have 100 shares and you just have the leaps, what would happen in that scenario is the broker would then use the leaps. It would be exercised. It would buy, in my case, the Qs at 400, and then it would deliver it to the buyer at the strike price that they purchased. So in my case, that would be like 500 if I sold the $500 calls. So that's how it works. I know a lot of you had a lot of questions. How does the mechanics of it work? And that's how it works. You basically are buying a placeholder to purchase something in the future at that strike price. And then when you're selling shorter dated calls against it, you're agreeing to give up that leaps, buy the shares, and deliver the shares at the strike price of whatever you sold on the call. And so it's important that when you do that, you actually have a plan, because if you just immediately, let's just say you get excited about what's happening in the market and you just go and purchase a leaps tomorrow. If you start selling calls against it before you've gotten over the cost of the leaps, then if it happens to be shut down due to the dynamics of what I just described, then you're at a loss because you paid for that. You need to get past that before you can actually start generating money without taking a loss on the exercise. And I wanted to also talk about risk management. So in my situation, I had actually opened up some of the leaps that I wanted to hold on to for quite some time when the Qs were trading at around, I think they were around 485. And I had actually purchased the 450 leaps expiring in December of 2027. Well, I always encourage all of my students to put a stop loss on their leaps or skips. The skips are the shorter dated calls that I use in conjunction with the leaps. But I always tell them to put a stop loss on them because, especially if the market decides to pull back more dramatically, and it did, and these, they're very expensive, so you definitely want to take precautions with them. So I had a stop on my leaps, the 450 Qs. And on April the 7th, when everything pulled back so dramatically, that stop loss kicked in. Well, what it did, though, I did lose money on that, but it preserved enough of what was left in the trade that I could then redeploy that capital. And I redeployed it into the $400 leaps expiring in December of 2027. And so today, those are sitting profit now, and they don't expire until December of 2027. So I've got a lot of time to use them to generate income. So let me go ahead and take you into the computer to show you exactly what I'm talking about. And then on the next big pullback for the SPY or the QQQ, you can consider doing something similar. If you look right here, you can see the full play. This is the Q's Leaps call option. It is for December the 17th, 2027, the 400 strike. Today, it's worth $148. You gained $8,000 just today. And then the total gain on it is about 119,000. You can see the current value. This is the percentage of account that it is, and then here's the quantity that I actually purchased. And you can see right here, I, on average, paid $88.51 a share, and they're worth $148 today. So here you can see the date that I actually purchased these, and it was on April the 7th, but I paid for it because I had the funding to do so when I stopped out of the more expensive trade that I had purchased earlier. And so this is the actual play itself. And now we have gotten over the threshold. If you take this 400 and you add the 88 to it, the Qs would need to be at 488 for me to start selling calls like I described earlier. And we are there. Now, here's an example of the daily income that I can generate on this trade. So you notice right here, this is the 497 call. This is a daily call that I sold against my leaps, and today it yielded about $207. I was very conservative on the strike that I selected. I went with 497 because it looked like that was not going to be reached, and I did this later in the day when the Qs had climbed. One thing I do notice, if you sell earlier in the morning before the midday, you will get a lot more premium because there's more of a risk to taking that trade early in the morning. When you're in the market for leaps, there's a few rules of thumb that I like to go by. One, I want to ensure it's a red day. Two, I want to ensure that if you're, say, buying a QQQ leaps, that it's at a good critical level of support and it's due to rebound. That could be a level of support using your moving averages or looking at your RSI. Typically, I like to purchase a stock or an ETF when it is oversold, and that's when it's around 30 on the RSI. When it comes time to select your leaps, you want to go at least 1 year out from the current date, and then you want to look for a delta anywhere between 0.7 and 0.8 for the purchased call. Now, once your leaps has gone up in price and it has reached the break-even point when you factor in the cost you paid for the leaps, I call that my leaps freedom day. When you go to select a shorter dated call against it, I always like to limit myself to no more than 1 week out, and I like to go super low in delta. If you can go below 0.2, it should keep you pretty safe. But if you see that the strike price is going to be breached and you don't want your leaps exercised, then you want to either purchase it back at a loss or roll it out further in time. Now, if you like updates like this and you want to ensure that you don't miss not one video, make sure you are subscribed. And while you're at it, go ahead and leave me a message in the comments on any ticker symbol that you are interested in me talking about next. I look forward to helping all of you through these crazy market times. I hope you are enjoying some green in your portfolios right now. It sure is nice to have all this green this last couple of weeks. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, I promised you that original video. I'm going to post that for you, and it's going to be right here.